Hello and welcome to episode 369 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, how are you doing? Welcome back.
I'm good, Andy. Anyone listening to this podcast, I am struggling a bit with my voice this week, so bear with me. I'm not going to be probably as emphatic or shouty as perhaps I am on normal episodes, and a bit croaky, so I will conserve my voice at this beginning part. But the reason it's croaky is because I went to Butlins for a weekend, and I sound like an old boy, but shouting over the very loud music for most of the weekend is taking its toll. And we're recording this and it's Thursday, so that was like 4 or 5 days ago. So I blame Butlins. My voice was left there. I was down there for a football tournament with my daughter and the whole family. So it was great fun, Andy. So yeah, I'm good, but I am slightly struggling in the voice department.
Okay, so I'm conscious of your voice, and actually on that, Damien, I've noticed that we haven't been chatting as much as we normally do. We normally catch up at least once or twice a day on voice chats, but everything's been done by Messenger this week. So let's save your voice for the pod then. Let's move on to what we're talking about this week. What have we got coming up for the listeners this week?
So there are 3 pieces this week. For a week where I've got no voice, I'm doing all 3, and I'm going to talk about Luna. So the lessons of Luna. Now, you may have read about the trouble in the crypto space, and in particular a stable coin and associated token that collapsed in value and basically imploded completely, meaning that lots of people lost life savings on this particular cryptocurrency. So I want to explain about Luna, what it is, or more importantly, what it was, and the lessons to be learned from what happened. And it's something that, even if you're not into cryptocurrency, is really worth listening to. I then want to do a piece on petrol prices. Now, petrol prices have hit an all-time high again, and I've done some analysis which I've not seen elsewhere, which crunches the numbers about how far it's worth driving to save money on petrol. So I look at the pence per litre saving that you see at the forecourts. How far is it worth going to save that money, and how much money do you actually save? Because there is clearly a point whereby making an excessive journey to save money is actually counterproductive, and it costs you more in the long run. And finally, I'm going to do a quick piece on a development in the mortgage market. So it's slightly contemporary, but it links nicely to the piece I did the other week, where I talked about preparing for coming off of fixed rate deals when it comes to your mortgage and interest rates rising. This is a little glimmer of hope and positive news for people out there who are worried about what will happen when they come to remortgage.
Okay, so let's start with the cryptocurrency piece then. And this follows nicely on the back of what we were chatting about last week. But Luna, something crazy is happening. You're going to try and pick it apart and tell the listeners what's happened.
Yeah, so last week we talked about the price of Bitcoin and how its behavior has changed, and actually how it's been tumbling in value. Now, part of that is obviously linked to, as I said last week, to the change in correlation with technology stocks, for example, where institutional investors are getting on board, and therefore when they're de-risking portfolios, Bitcoin is one of the assets that they also sell alongside their technology stocks. So the correlation between tech stocks and cryptocurrencies, particularly Bitcoin, has hit an all-time high, and they tend to move in tandem up and down. But in the last week or so, there has been an earthquake effectively in the world of crypto that has seen all cryptocurrencies hit, and it's because of something that happened with Luna. Now, before I go on to Luna and what it is, if you are interested in cryptocurrencies and you've not listened to the Explainer podcast we did before, we'll link to it in the show notes. But you can also go back to episode 321, which was the beginner's guide to Bitcoin and cryptocurrency, where I explained all about cryptocurrencies. And in fact, if you search Bitcoin podcast, so those 2 words, in the top right-hand corner search box on our website at moneytothemasses.com, you'll find all the content that has been on the podcast that contains the word Bitcoin. So that's one way to search. But just to give you a brief overview, cryptocurrencies, of course, everyone thinks of Bitcoin, and that's the most dominant of the cryptocurrencies, most well known. And you've also got Ethereum, which we talk about in that previous podcast, which is a whole ecosystem with its own blockchain that gives rise to the tokens that form the basis of NFT trading that goes on out there. Again, we've done podcasts on NFTs, you can go and listen to that. But then you've got these other sort of third generation blockchains that exist, and Terra is one of them. And Terra is unique in that third generation of blockchains because the whole aim of it is for use in the real world. So it's aimed at real world people, really. And the idea behind Terra was trying to build perhaps a better Stripe or PayPal with the use of a blockchain. So they were trying to construct a ecosystem whereby people would start using a digital currency in the real world. And of course, one of the criticisms of Bitcoin is the price is so volatile that you can't use it to go and buy anything realistically, because by the time you went and bought a cup of coffee, between ordering it and paying for it, the price of Bitcoin would have fluctuated possibly significantly, that it makes payment impractical. So Terra aimed to offer the same decentralized peer-to-peer advantages of something like Bitcoin, but it wanted to create a stable value. So it wanted to create this ability for people to start using it in the real world. Now, one of its perhaps most controversial features is an algorithmic stablecoin. Now, Terra uses two tokens. One's called Terra UST and one is called Luna. And Luna is Terra's native token, whereas the UST is the stablecoin. And a stablecoin is one that will track the value of a fiat currency. And when I say a fiat currency, that would be something like the dollar. It could also be something like the euro. So the idea behind a stablecoin is that you could peg it to the value of a dollar, for example. So therefore, its price wasn't fluctuating, but this stablecoin would be a digital currency that could be used in a similar way to things like Bitcoin and have those advantages, but its value would remain a dollar. Now that sounds very useful, because if you think in the real world where dollars are used globally all over the place and accepted all over the place because of their reserve currency nature, so people trust the dollar, then if you had a decentralized digital currency that effectively followed that, it was pegged to that dollar, then the idea would be that that would possibly then become a currency that would be used all over the world, but it's decentralized, which means governments and central banks don't have control over it. Now, just to explain, a stable coin can be achieved in one of three ways, really. So you can have a cryptocurrency that's backed one for one with a real asset like fiat currency. So, for example, one coin, whatever your stable coin might be called, would be backed in the real world by $1. So it would exist. So there's effectively a collateral of $1 somewhere, so that people would then have faith in the idea that this coin was worth $1. An alternative method would be to have, instead of being backed by a physical dollar, then maybe the stable coin would be backed by a collection of other digital assets, so other cryptocurrencies of sufficient value that they ensure that the stable coin can maintain its relation, its peg they call it, with the US dollar, for example. Or there is a third way, which again doesn't use real assets, but it's done using an algorithm. So there is an algorithm that works that ensures that the value of the stable coin remains at $1. Now, that's the high level thinking. So in the Terra ecosystem, you've got these two tokens. So you've got the Terra UST, I'll call it UST for the rest of this podcast, and then you've got Luna. So the UST stable coin and the Luna token have a relationship. And it's these two things, the way they work together, that ensures via the algorithm that the UST stablecoin maintains its peg to the US dollar. Now, you don't need to understand how they work, but effectively, Luna absorbs the volatility of the value of the UST stablecoin. And what happens when you get a demand for one of them, so let's say lots of people want the UST stablecoin because let's say there's apps or whatever it will be that has a demand, or people, let's imagine people were generally using it to buy cups of coffee. The more people want to buy cups of coffee, the more they would want this stable coin. Then the demand goes up. Then to counter the rise in value and demand for that stable coin, what would happen is they would create more of that stable coin, so effectively reducing its value. And the way they do that is by destroying these Luna tokens. And the key thing is that the Luna tokens and the stable coins can be exchanged for each other. And so $1 of Luna can be exchanged for one of the UST stablecoin. Again, you don't need to understand how it completely works, but in reverse, when the price of the stablecoin starts to fall below $1, what they do is create more Luna by burning more of the UST stable coins. So if you've got to think of it like a sort of seesaw effect, and the idea is the algorithm works to ensure that the stable coin always stays valued at $1. And of course, it had worked well up to this point. So what's been happening to the whole Terra ecosystem and to the stable coin and Luna is it became incredibly popular. And the whole ecosystem around it was being built with lots of developers and apps that would use the stable coin. And so there was a belief that this was finally getting mainstream appeal. It was going to be stable. It would work. It'd been almost tested in the real world. And if you go online, you will see a lot of influencers, and I'm talking about people who particularly operate in the crypto space, talking about how this was the cryptocurrency they thought was the most robust and where the opportunities lie to make money. And just to emphasize how big this became, the Terra Luna was one of the top few cryptocurrencies in the world, and it had a market cap. So the total market cap, if you took the Luna token and the stable coin, of about $47 billion. That's an enormous amount of money. So that shows you this wasn't something that was tiny. This was a significant operation in the crypto world. Then what happened about 2 weeks ago? The peg on the stable coin broke. And the reason why it snapped is up for debate. But one rumor is that a trader deliberately tried to break that peg by selling hundreds of millions of pounds worth of the UST stablecoin. Of course, that then started to force the price down, which was enough to snap the peg, because then people started to panic because the price started to fall. They then didn't think they were going to be able to exchange their stable coins for Luna. As soon as people started to lose faith in the way the algorithm might work and the whole ecosystem itself, it basically then came crashing down and people started rushing for the exit. And the result was obviously that people started to lose faith in cryptocurrency generally, which started to put downward pressure on all other cryptocurrencies, including Bitcoin. But interestingly, there is something called the Luna Foundation Guard, which is LFG for short, which apparently are the official stewards of Terra's Bitcoin reserves. And they effectively sold millions of dollars worth of crypto to try and maintain the peg of that Terra stablecoin, which is the aim of that LFG. And obviously they have proved unsuccessful in doing so. So selling lots of Bitcoin will obviously put downward pressure on the price of Bitcoin as well. And so there's a theory that the person who did bring the whole Luna project effectively down did so because they were placing a short position, i.e. betting against the price of Bitcoin, effectively betting that the price would fall. Now, I've given a broad explanation there that is very high level. There is lots of nuance to it. And quite frankly, it's probably not the best explanation you're ever going to hear, because the whole Luna project is incredibly complicated the way it works. The interactions between the stable coin and the Luna token and all of that is very difficult to understand well. And I spent a lot of time looking at this. And therein lies one of the lessons from the whole debacle, is if something is very difficult to understand, then it is often best left well alone. Because when you look at the sources of information out there, there's a lot of YouTube videos made by some very big influencers in the crypto space. They become very big because they have channels dedicated to crypto, and they talked very positively about the whole Luna project. And there's been lots of people who have been sucked in to the whole Luna project and now have lost their life savings. And you see some of the comments. There are people who are suicidal. There are people who have talked their family and friends into investing in Luna. There was whole other elements to this that I haven't gone into about the yields that you could get, apparently up to 20% effectively return on your money that was coming from an equivalent of a savings account in this space. And people were all drawn into it. And the project has now seemingly completely collapsed. And any money in that project has completely been lost. If you go and look at the value of Luna or the UST, it's effectively worthless now. And KSI, if anybody knows, he's that really big YouTuber, even went on Twitter almost making light of the fact that he'd lost $3 million on this. And so there are a lot of people who've got a lot of money invested in Luna. And the reason I wanted to talk about it on the podcast is the lessons that are learned from this. Now, this isn't a kind of "I told you so" piece or anything like that, because there are going to be people out there who have lost money on this project, and they're unlikely to be people who obviously listen to us because we don't get involved in these things. And what I wanted to focus on was there was a very interesting YouTuber who I started looking at some of his videos in light of what's happened, and you can go through and see some explainer videos about Luna, and then he talks a lot about how positive he is, and this channel has over 100,000 people on YouTube subscribed to it. And of course, the creator of the whole Terra project almost seemingly went quiet when it all started to go wrong, and there were people getting frustrated with that. They lost money, they wanted answers. And this YouTuber, who was very bullish on the idea, invests in crypto, gives advice about investing in crypto, he came out and did a video which I watched, and obviously the difference between the video I watch now, which was the aftermath video, and the one that was made maybe 6 months ago, obviously night and day. He looks a bit of a shell of a man, to be quite frank, and the reason he made this video was to effectively apologise to his 100,000 YouTube subscribers for effectively sucking them into this idea of Luna. Yes, he didn't make them buy, but he did talk up the whole project and about why it was good to invest in it. And if you look at the comments of his videos, there are lots of obviously people very scathing of him because he's lost money. But he made this video, which was effectively him to apologise to the world and what he was going to do moving forward. And what was interesting is he started to talk about what he'd learned from it. And the reason it's interesting is because what he started to talk about, what he was going to try and do next, is a lesson for everybody about what we talk about on this podcast, which can seem a little bit boring, is based upon sound practice and lessons that have been learnt by lots of investors over a long period of time. So an example was, he said he's going to go and read a book on portfolio management, just one book. I wonder why he was going to read one book, and then he was going to do a video about the book he'd read, which again I think is the problem with things on YouTube. People become experts very, very quickly, or self-proclaimed experts, by reading a book or something that's very exciting that they get interested in, and then they talk about it. And that in itself is another sort of red flag about the fact that he's going to read one book about portfolio management. But interestingly, what I wanted to highlight is that now he's realizing that perhaps he should have learned a bit more about managing a portfolio. And that is the lesson that I want people to start to take away from the podcast, that these things we talk about on portfolio management is important. And he now wishes he'd learned that lesson previously. It's a lesson to anybody out there. When you're managing money, you need to manage the risks, because the subsequent thing he said is he wished he'd paid as much attention to the risks as he did the opportunities, and perhaps his video should have been a bit more balanced. Again, therein lies a lesson, and we talk about investing on this podcast. We talk a lot about risk and risk management. Understanding the risks of anything are key, because had he done a bit more research, he did mention in an early video about one of the potential risks was about this peg breaking, but he didn't focus on it enough. On a 20-minute video, it was a 10-second aside, and he said he wished he'd paid a bit more attention. Therein lies a valuable lesson for everybody about look at the risks, focus on the risks. Even when you're putting money in a bank account, what are the risks to that? For example, could you get a run on the bank? Because that's effectively what we saw here. We had a run on a cryptocurrency, but what are the risks in that regard? And about the financial services compensation scheme, you put money in a bank, you can spread it around different banks and make sure that you remain within that compensation scheme in case you get a financial crisis style event that we had before, where banks were potentially having runs on them. You'll get your money back. Just to reiterate that point, the financial services compensation scheme, if your bank is covered, you are covered for up to £85,000 per banking license, not banking brand. Some banking licenses have multiple brands on them. First Direct, HSBC is a good example, or £170,000 for a joint account. So that is about risk management. The other thing is he lamented position size. So he put all his money in this stuff. And one of the things that when you invest is you learn is you should never put a lot of money into anything. You don't want to put all your eggs in one basket, but you certainly don't want to have one basket that has even more of your eggs in, even if you have multiple baskets. So one of the lessons he's learning now is about position size. So if you are going to make a speculative investment, you should acknowledge that it's speculative, you may lose your money, but do it with a very tiny amount. And typically in portfolios, you never have more than 5% in anything anyway. It could be 10%. It can be more as long as you acknowledge the risks, but you diversify. And one of the other things is that he talked a lot about intelligent people, how many intelligent people are in this space and how he believed in it and how he still believes in it because they're the smartest people he's ever met that are in this whole sphere and why he believed it will make a comeback. And again, I think there's a lesson there that being intelligent is nothing to do with making good money decisions or good investment decisions. In fact, keeping it simple, stupid, the whole KISS principle will serve most people quite well in the investing world. So don't try and do anything crazy. Why be the first person on the next innovation, whether it be crypto, whether it be the next investment opportunity, or whether it be the next investment trend, like the next rally in a particular stock market? Keep things simple, be boring, and to manage risk. It's the heart of everything. We have a tendency to look at returns a lot. So I'm talking about investors tend to always focus on, I wish I'd been invested in this fund or this investment because it made this amount over a period of time. Yet that's not risk management. That's just looking at the past with the benefit of hindsight and wishing you'd taken extra risk. Risk management is where you're managing the potential downside that can happen through a process. And that is the way that you try and minimize the potential of losing all your money, but equally trying to gain some of that upside. So if you manage risk, you are not going to make as much money than somebody who just lucked out potentially, but you probably won't lose anywhere near as much money as the unfortunate person who got sucked into something that they didn't understand. And of course, there will be people who point to things like what happened with Neil Woodford, who was an established fund manager. But again, that would be a lesson on position size. So don't overinvest your money into one particular fund or anything, because even if the past history and you think all the regulations there that's going to protect you, still you need to diversify in case things go wrong.
Okay, so the next piece then, we're going to be talking about petrol prices, and news hit this week that prices have hit all-time highs, and it made you stop and think. And so Damien, with your spreadsheet knowledge and your maths background, you went and did some digging around and have provided something for the listeners.
Yeah, so I fell down a hole. Anyone who knows me knows once I get my teeth into a maths problem and a spreadsheet, then I'm gone. I'm not eating or anything until I solve it. Basically, we were talking about this all-time high petrol price, and it's now got to 167.64 pence per litre on average for petrol and 180.90 pence per litre for diesel. So this is, as I say, an all-time high. So we were talking about the idea of what you can do about that. We've done a piece on the podcast before. I think you did one, Andy, about how you can try and cut back on your petrol bill, partly to usage, the way you drive. And we can link to that in the show notes. But one of the key ways you can just simply cut back is by using petrolprices.com, which is a website and an app. When if you register, go on it, it's free. It will tell you the cheapest place to buy petrol in your area. In fact, you can filter it from cheapest to most expensive, but also you can extend the area beyond just your local area. You can just make the size of search as big as you want, effectively 20 miles if you wanted to. And so there are some significant differences in the price that you pay at different forecourts. And you can use the Waze traffic app, so the SatNav app, which I think a lot of people use. You can download it on your phone, Waze, W-A-Z-E, use it as a SatNav, the best SatNav in my opinion, pretty much out there. But it also has petrol prices in that users put in. And so we were talking about how we look for different petrol prices. And Andy, you're always saying about when you drive into work, the difference in petrol prices at different forecourts.
Yeah, absolutely. I mean, there's a massive 10p difference between two petrol stations that are, I would say they're less than 2 miles apart. So I can only imagine that difference is even bigger the further you drive. And so, yeah, it's just, what do we do as consumers?
Well, that was the interesting question that we were debating. Would you drive a certain distance to get petrol? And at what point does it become counterproductive? Because you could drive a mile or two out of your way to save a penny or two on petrol. But is that worthwhile? Is the cost of the journey, because of the amount of petrol you're using, exceeding the amount you save? So I was looking at it, and of course, all the pence per litre stuff doesn't really mean a lot to me. I mean, I can see that, okay, that was going to be maybe a couple of pence, 10 pence cheaper. It might do a percentage in my head. How much will that save me on a tank? But of course, it doesn't really mean anything to people. So what I wanted to do was actually crunch the numbers that answer that question about when it's worth driving around. So we've nailed down, if you use something like petrolprices.com, you can find cheaper petrol. The question then becomes, is it worth driving to that garage to go and find it? So my insights and number crunching answer that question. So I crunch the numbers based upon a few assumptions. So miles per gallon of an average car. So if it's a petrol car, it's 36 miles per gallon. If it's a diesel, it's 43 miles per gallon. I also assumed that most cars have 50-litre tanks. That's apparently the average. And I use that information and with the average petrol price data that I just spoke about to work out how far it's worth driving to save money. Now, I produced a table, which is a great crib sheet to glance at, which we've shared on socials, and it will be a link to in the show notes, and will be on the post on the website for this particular show. But I want to run through the numbers now for people, but I also going to give you a very simple way of remembering when it's worth driving to save money. So when you crunch the numbers, if you see a petrol station on an app, for example, that is 1p a litre cheaper, then on a full tank of petrol, that is going to save you 50p. And based on the average miles per gallon for a petrol car, it is only worth driving to save that 1p if it's within 2.4 miles of you. So you're not going to go a 2-mile journey out of your way to get it. So obviously the aim would be always to try and get petrol when you're on your usual journey because you're not going out the way. But obviously sometimes you will want to go out of your way to get petrol if it means you can save money. Now on diesels, the number's slightly higher. For that 1p saving, it's only worth driving up to 2.6 miles to save the money. And that compares to the 2.4. Now, if it's 2p per litre, then you will save £1 on a full tank. And then it's worth driving 4.7 miles to get that saving maximum in a petrol car and 5.2 miles on a diesel. Now, as I say, I'll share the full table. But when you can save 10p a litre, which is a number you mentioned earlier, Andy, 10p a litre, you will save roughly £5 every full tank. And that means it would actually be worth driving 23.6 miles in a petrol car and 26.1 miles in a diesel car to get that saving. Well, obviously, if you drove the 23 miles, that's the point on which you wouldn't be making a saving. So it's got to be a lot less than that. Now, if you can save 15p a litre, then you're saving £7.50 on the tank, and that distance goes up to over 30 miles in which you could drive to make that saving. Now, if you look at the apps, I looked at it today, and you can easily see that difference. So if you happen to go to the most expensive petrol station, you could be saving yourself £5 by going to the cheapest one. Now, those numbers I've mentioned are difficult to remember in terms of how far to drive, but an easy way to remember it is that for every penny per litre that you can save, it's only worth driving 2 miles for it. Soon as you drive more than 2 miles, then you're probably spending more in petrol than you are going to save by going to that petrol station. So it's the 2-to-1 principle. So that would be an easy way to remember it. And don't worry about the difference between petrol and diesel. We just stick to 2-to-1 because it's easier to remember. The 2-to-1 principle is only worth driving 2 miles for every penny that you save. As soon as you do more than that, you're not saving money. So if there is, for example, like you gave there, Andy, a garage just 2 miles down the road that's 10p a litre cheaper, then it's definitely worth saving, because 10p a litre, you'd go up to 20 miles to save that. So if it's 2 miles down the road, then it is worth going out of your way. Of course, if you're not going to use a full tank, because you've probably got half a tank that you need, you're going somewhere, you need to top up, then that 2-to-1 principle, you have to halve it. So it's only worth driving 1 mile for every 1p per litre saving that you have if you're only going to fill up half a tank. So there you go. That is a rule of thumb that makes all of this penny per litre and all these numbers that you see on the news and everything far easier to understand and actually put into practice when it comes to trying to save money on your fuel bill.
Okay, so let's move on to the final piece then, and we're talking mortgages, and there's been an interesting development in the mortgage market.
Yeah, so I'm doing this piece on the podcast, and it's slightly contemporary because things do change. But a couple of weeks ago, I did a piece about what people should be doing now, even if you're on a fixed mortgage in light of the world we're in, and interest rates could potentially go up, how you need to get your finances in order, make sure they are before you might potentially have to apply for a remortgage. Now, obviously, one of the things that if we do have a recession, no one knows if we are going to, but if the world gets more difficult, people might end up having a reduced income. They might end up having to change jobs for some reason, and they might end up earning less. And also don't forget that their costs are going up, so the bills, etc., are going up, which obviously makes remortgaging that little bit difficult. But it was just a bit of a ray of sunshine that I wanted to share with people, because Nationwide has changed its income multiples, and it's now up to 6.5 times salary for remortgages where the borrower isn't increasing the loan amount. So they're sticking with the level of mortgage that they've currently got, and they're just wanting to remortgage. And it's a deliberate move that's designed to help people whose circumstances have changed since they took out their original mortgage. And like I said, that's specifically people whose income levels have dropped. It could also help people who no longer meet other lenders' tightened affordability criteria. Of course, there are criteria you have to meet. Like I said, you have to have the same level of mortgage. You can't take out more money, but the loan amount can only be up to 90% loan to value. But on top of that, you also need to be considered a prime lender, which means you've got to have a strong credit rating, which goes back to the podcast piece I did a couple of weeks ago, which talked about making yourself a prime lender, basically having a strong credit rating. You need to do the work now, so you have options like this open to you going forward. So it kind of also backs up what I was saying in that particular podcast. But it is a bit of a ray of hope. There are lenders now that are increasing their multiples, or at least there is one. But do keep working on your finances. Then you will have more choices when you get to that remortgaging point. So as ever, I would always suggest you go and speak to a mortgage broker who can search the whole of the market and recommend a product for you.
Yeah, it's an interesting development, and where everything's so much bad news at the moment, this could be, like you say, a lifeline to certain families where situations have changed. And those situations could be where perhaps one parent has given up work because of childcare, or maybe they've been made redundant, retired, or maybe they've changed jobs completely and gone from being employed to self-employed. So Nationwide making the move up to 6.5 times salary, and that's a big jump because it was previously 4.49 times salary, is a really positive thing. And actually, Damien, I'm interested to see whether other lenders will follow suit.
So that is it for this week, Andy. As ever, please do leave us a review on the podcast. We will be reading out some of the reviews in a future episode, because we've had a bunch of them, and it'd be great to get even more and we can read them out. So please do leave a review on whatever app that you use, and who knows, you may get a Money to the Masses mug. I've sent out a couple this week to people who'd sent in feedback, and I always like giving away mugs where possible. As usual, don't forget to join our Facebook group. We've just hit the 4,000 mark, so 4,000 members, so that's fantastic to see. We're close to hitting 10,000 on Instagram too, so make sure you follow us on Instagram. The Facebook group is facebook.com/groups/Money to the Masses. And also don't forget to follow us on YouTube as well, because I'm doing lots of videos, not this week because of my voice, but we are doing lots of videos on YouTube as well. And I'll just give you a bit of a teaser, because I think we got a new show that's going to be coming out on YouTube that I think a lot of people would quite like. So more on that on a future episode of the podcast. So that is it for this week, Andy. Until next time.
Until next time.